Good morning, everyone. Welcome to this update for global markets for the 15th of May. Not a lot happened not a lot changed in the last week. So markets, particularly the S&P index, remain very much in neutral. So let's have a look at the action for the week. US, the main index was down by 11 points. And we're still in this situation where we could really make a case either way. So the direction still to be resolved, as it has been now for quite a lengthy period of time. US dollar was higher. That's generally not a positive for American stocks because so many of the big stocks that impacts their overseas earnings. But it did have a bit of a positive feed through regardless. Now, probably the biggest point of volatility during the week was that some of the bricks and mortar retailers, such as Macy's, came out with some very, very poor sales and very poor outlook. And that triggered a real sell-off. We saw Macy's down by around 15%. We saw Nordstrom down by a similar amount on Friday, and so that really triggered a reversal in the US market, at least a short-term one. But really, when you dig deeper and you look at the results for Amazon, which were good, and also the price of Amazon is basically trading at an all-time high, then it's pretty obvious that sorry, just get rid of that. It's pretty obvious what is happening here is that there is a massive transfer underway in sales from bricks and mortar stores to the internet. And that's something that's obviously been developing for quite some time. And so I don't think it's necessarily a indicator that the US consumer is in trouble. Apparently, retail sales as a whole, if you look at internet plus the mainstream stores, is okay. There's growth there. So at first glance, it looked like a significant problem, but on reflection, it isn't really. And I think the US consumer is still basically saying that they're okay. Now, the average earnings, we're pretty well through US earnings season now, and average earnings are down by 7.1%. And that is 4 consecutive quarters of decline, which is the first time that's happened since 2008, 2009. So again, you could say, well, gee, that's a really poor sign, and maybe the American market is heading towards recession. However, you've got to factor in the fact that that energy earnings are down massively, and so that certainly is a bit of a drag. Now, I don't believe you can exclude those things and just ignore them, because it is a fact that the earnings for energy companies are down heavily, and that does have a flow-through effect on the rest of the economy. But nevertheless, it does just kind of mediate it a little bit. Now, the indicators for American stocks, I mean, obviously the debate is, are we in a topping formation and about to head down for a significant correction? Or is this just a pause that started in 2014 and will eventually go into a renewed uptrend? The answer to that question is we still don't know. However, I think the odds are more in favour of this being a pause, perhaps in an ongoing uptrend, rather than a top, because the sentiment is just not buoyant enough for a top. You know, tops form when everyone's in the market, and the sentiment has been awful. Sorry about this, keep popping up. Sentiment has been absolutely awful through this whole period from 2008. So this is just not typical of a top at all. So to me, it's seems like more of a wall of worry kind of scenario. Now, the economy is not poor enough for a top, considering interest rates. So I don't see a recession. I think it's going to be more of the same. The economy just stumbling along at a rate that's lower than what people would like, but not poor enough for a recession. And overall, the technical patterns, there's some positives, some negatives, and you can seize on one or the other, but they remain neutral on balance to my way of thinking. So let's take a look at the the American market. So this is the S&P index on a big picture level. This is the big monthly chart, and you can see that we've really been locked in this sideways pattern here. We first got a bit of a plunge in October, of 2014, and so it's been bounded by this area here between 1820 and the peak around 2130 for getting on forwards 2 years now. If we zero in a little bit, and so we're really none the wiser on that big picture level. If you look at the daily chart, you can see that we've really been in a consolidation here between, again, 2020 on the downside and around 2112 on the upside, and that consolidation started in March. So we're almost 2 months into a smaller time frame consolidation there. There's no particularly significant candles, particularly to the downside. Volumes remain on the lightish side. There's just really little commitment either way. I'm not seeing a great commitment to buy, and I'm certainly not seeing a great commitment to sell either. So you've got to say that until the market shows us differently, that we're just going to continue this sideways grind, and there's not a lot else is changing out there. Look at the Aussie market. The US dollar rose, and so that pushed the Australian dollar down. We're back down to 72.5, and that's been a very, very sharp slide from above 78 in just 2 weeks. It's mostly about strength in the US dollar in the last week, although there's a little bit of a factor there from lower commodity prices as well. The ASX 200 was up by 37. This time it was the turn of the miners to go down and the banks to go up. So they're just basically flip-flopping from week to week, and our market is no different to the US market. No one really knows which way it's going to go. Turning now to I guess the main story of the year, and that's precious metals. Gold and sorry, just let me get rid of that. Gold and silver are slightly lower for the week, but which was pretty impressive, and because they weren't lower by the amount that the US dollar was higher. So the strength in the US dollar has really failed to have a significant impact on precious metals prices that you would normally expect. So I just continue to see great strength in this whole sector. Stocks are mixed, some up, some down over the week, but still outperforming the metals as a whole. And some precious metal stocks are just continuing to rattle on forward. And of course, they're the ones you want to be focused on. And members of Special Share Education know very well which stocks they are. So it's been a terrific run. Stock PE ratios are something that some of the more negative commentators are pointing to, that some gold stocks are trading on PEs of 20 and 30 and 40. But look, that can be grossly misleading for a couple of reasons. First of all, they're looking at trailing earnings rather than current or forward earnings. And you got to remember that the price of gold, it was only in December that the price of gold was hitting its all-time lows. So, of course, the trailing earnings are going to look awful. But the price of gold has moved up, and that has increased the earnings of stocks quite dramatically. So to look at trailing earnings, I think, is misleading in the extreme. That's just trying to make a negative case where one really doesn't exist. But the second factor is that under the accounting rules, particularly in America, there's a lot of non-cash items like asset write-downs that have occurred, particularly over the last couple of years, when the asset values have had to have been written down, and they're not being revised upwards. So that's actually a drag on earnings. So not only is the low gold price been depressing earnings, but some of these non-cash write-downs have been depressing earnings as well. So when you wrap it all up, some of these PE ratios are just bear no resemblance to the way that the companies are trading now, or in fact the way they will be trading in 2016-17. The reality is that so the message out of that is if you see a stock that has a very high PE ratio, then you need to look more closely and not just accept it on face value. The reality for the gold miners and the silver miners is that profits are rising very quickly. And if we get a rising gold or silver price, and as you know, I've said all year that my bullishness on the sector was not contingent upon gold and silver prices rising. This was merely a mean reversion through the stocks relative to the underlying metals prices, and that gold and silver didn't need to move, particularly gold didn't need to move for those stock prices to go up significantly. Now, however, if we do get a rising gold or silver price, then profits are going to soar exponentially, because that's just the way it works. The miners' costs are effectively fixed, and the impact on profits is quite exponential. So I believe the biggest gains are still ahead of us. Yes, there's been some terrific moves, 100% in a few months, 150% is absolutely common. The group of 40 or 50 American precious metal stocks that I follow, there wouldn't be too many that haven't at least doubled this year. So I believe that this is the start of a very lengthy bull market, but there will be significant corrections. And history shows that, however, that precious metal stocks, when we get into a new bull market, they run a long, long way, a lot further than anybody really anticipates, and they run for quite a long period of time, certainly several years. So the absolute risk to me is reducing quickly. So what I mean by the absolute risk is the risk that you can lose money permanently, that you buy in at a certain level, the prices drop and they don't ever come back for a long, long period of time. So I think that absolute risk is reducing quite quickly. However, the volatility risk is still extremely high. And what I mean by volatility risk is the short to medium term fluctuations in price, which could be 20, 30, 40%. And most people's psychology cannot deal with that level of volatility. So the next few years is just so much about trade management. So I really want to make an important point here. And honestly, this is not a point about sales or selling my services. That this is the reality that you need, but most people are going to need some significant level of assistance in managing trades. It's not about the recommendations are important, but it's not about the recommendations. Your success in coming years in this sector is going to be very much about how you manage the trade. There's two components to that. There is a mechanical component. In other words, how do you take profit? How do you manage your risk? But the second part is very much about your psychology. How's your confidence going to hold up during this period of extreme volatility? So to me, that's the key. So let's take a look at precious metals. So if we look at, let me just get this correct. XAU USD. So this is gold on a weekly basis. So you can see we've had quite a dramatic move from the start of January. So here we were just 5 months ago at multi-year lows. So of course any earnings figures that you look at will be completely meaningless if you're looking at trailing earnings. Big surge from 1,060 odd. We went up to around the 1230, 1240 mark, and then we've really just gone sideways to slightly higher. There's been no retracement at all, and that in itself is a measure of great strength. There's the daily chart. We ended up down a little bit on the week, but still pretty impressive relative to what the US dollar did. And this is silver on a weekly. You can see silver also showing great strength, and this is starting to bring silver miners back now from a position where they weren't making money to being profitable again. Let's just look at the HUI index as an indicator of gold stocks in general. So we've had a very substantial move, as you can see, and really no retracement there at all. We've broken through several resistance levels without any difficulty at all, and that really presents the dilemma with precious metal stocks at the moment. If you buy in at this level, obviously the higher it goes, the closer we are to some sort of meaningful pullback, which will occur. That there will be a pullback. This is not just going to go straight up, and I would expect that pullback is going to be. You'd have to expect at least 20 to 25% pullback. If you're not factoring that in, then you're just not being realistic. So there will be a pullback. However, could this trend continue higher before it does that? Absolutely. We're just seeing enormous strength in this sector. So that's really the dilemma. So at the moment, it's very much about how you manage your exposure and how you manage individual trades and take profit. Moving on now to general commodities. Copper was down to 211. It's really just tracking the currency. Crude oil went a little higher, so it's going against the currency. The trajectory is still upwards, which is not really consistent with the fundamentals. However, there are some signs that maybe the balance between supply and demand is improving a little bit. It's still out of balance, but the market is looking forward. It's trying to anticipate where things will be in 6 to 9 months' time. So, perhaps there is a little bit more of a reasonable basis for oil doing what it's doing. So there's the spot copper chart. So just to wrap it up, my strategic thoughts, there's going to be a great deal of uncertainty through to year end that are going to keep markets very nervous. And so that's why I'm not saying we're going to get a renewed uptrend in the US market. We may just continue to bumble sideways for some time. For a start, we've got the US election. Both candidates bring an awful lot of uncertainty for stock markets, either Clinton or Trump. And I think as that election progresses, the markets will remain very much on alert because they're both wild cards in their own certain ways. We've also got the potential of Britain exiting the Eurozone. That'll come up in a few weeks' time. But there's a raft of other things that relate to China, Japan, other matters, economic matters in Europe. So there's a whole raft of things that are going to keep markets on edge. Through all this, you've got to learn to ignore the noise, particularly if you're an investor. But equally, you've got to be responsive to the trend changes. So again, this is one of these tricky fine lines that we've got to walk, where you certainly don't want to adopt a position and just stick with it through whatever, because it could be a significant trend change. And we've seen quite an amazing negative trend change in biotechnology. We've also seen a change in Apple and all the semiconductor sector as well. Now, neither of those things looked on the cards in the middle of last year. And if you've just stayed with those sectors, then you would have incurred some significant losses. Those sectors are down between 30 and 40%. So you can't just adopt a position, in my view, and stick with it. Yet equally, you don't want to be reacting to every flinch in the market every time there's some announcement gets made that causes markets to dive around. So it really is a very, very tricky line to be walking at the moment. Precious metals unquestionably are the strongest trend in the market, but as I discussed before, they currently present quite a significant dilemma in terms of raising your exposure from here and then managing your trade. So terrific opportunities. I've been saying this all year. Great opportunities, but not necessarily that easy to get your hands around. So for those that aren't members and would like some assistance with that, there's my contact details. There's certainly been a big upsurge in the amount of contact that I've had in recent weeks. I guess that's partially because fundamentals or the situation with precious metals has, I guess, sparked people's interest. But if you would like some assistance, then there's the contact details. Would love to hear from you. That's it for this week. Cheers.